In the media industry's most major restructuring in almost 40 years, Singapore Press Holdings is looking to transfer its media business to a not-for-profit company called SPH Media.
A not-for-profit structure will allow SPH Media to seek funding from public and private sources with a shared interest in supporting quality journalism. It will also be able to reinvest its operating revenue into its media operations.
While explaining the rationale behind this move at a press conference this morning, SPH Chairman Lee Boon Yang said the media industry has faced unprecedented disruption in recent years, with SPH's operating revenue halving in the past 5 years.
This largely due to a decline in print advertising and print subscription revenue. Among SPH's publications are the Straits Times, the New Paper and Lianhe Zhao Bao.
The media business is expected to remain loss-making and to face severe financial challenges over the next few years. SPH shareholders are not likely to tolerate the continued negative impact that the media business has on the company's financial prospects. On the other hand, we cannot allow a functioning, trusted and respected media organization to be whittled down over time by market pressure and commercial constraints. It is therefore clear that being part of a publicly listed company is no longer a tenable model for SPH Media. A new funding model is needed for SPH Media to remain financially sound and functionally robust in the long run.
The restructuring involves moving SPH's media-related businesses to SPH Media, including relevant subsidiaries, employees, news centre and print centre, along with their respective leaseholds or related intellectual property and IT assets.
Under this proposal, SPH Media will eventually be transferred to a not-for-profit entity for a nominal sum. This will be a newly formed public company limited by guarantee or CLG. A CLG is an entity that does not have share capital or shareholders. Instead, it has members who act as guarantors of the company's liabilities.
At the start, SPH will provide the initial resources and funding with a cash injection of $80 million, $30 million worth of SPH shares and SPH REIT units, as well as SPH's stakes in 4 of its digital media investments.
This is on the basis of enabling the HoldCo post-injection to the CLG to have a reasonable runway to take off into its new chapter under the not-for-profit CLG. We expect this injection of capital to give it the time for the next 3 to 4 years maybe, depending on circumstances, to reach a safe landing in terms of a long-term sustainable funding model, which will involve public-private partnership. As a non-profit organization, obviously, it would be able to source additional public contribution, which SPH Media is not able to do while it is part of a listed company. It is also possible for the CLG to receive additional financial support from the government to help it to achieve its mission as a public information provider for Singapore.
Asked how SPH Media would preserve its editorial independence while receiving external funding, including possibly from the government, Dr. Lee said SPH's media business has striven to serve its readers in an objective, accurate and responsible manner.
I believe that over the 37-odd years or so, they have achieved this mission of serving the public, the news consuming public, and earning their trust and confidence. Trust, confidence, and also respect as a reliable source of news and information. And these values are deeply embedded. You can say it's the DNA of SPH Media. And these are values that will also be ported over to the CLG, so that they will clearly be charged with the mission to preserve this level of responsible, objective, and accurate journalism.
The Straits Times' YouTube channel has the full Q&A session in which Dr. Lee and SPH CEO Ng Yat Chung answer questions from the media.